Welcome back. Take a look at the futures this morning. Markets are trading lower. Dow Industrials down 70. The NASDAQ down 15. The S&P 500 lower by 7.5. Interest rates, meanwhile, trading this way ahead of the Federal Reserve kicking off day one of its two-day policy meeting. This is the first monetary policy meeting of the new year, and the 10-year yield is now at 4.06%. That is down 1 1/3 basis points. The Wall Street Journal's Nick Timiraos writing that the central bank is feeling the pressure to cut interest rates as falling inflation raises the real cost of borrowing. Joining me right now is the Wall Street Journal's chief economics correspondent. He's the author of The $1 Trillion Triage. Nick Timiraos back with us. Nick, great to see you. Thanks so much for being here. I want to get back to that piece you wrote the other day about this dilemma that the Fed faces. Yeah, sure, they want to cut rates, but how are they going to do so if, in fact, the real nominal rates are actually impacting economic growth? Walk us through that issue right now.
Yes, Maria, thanks for having me. It's a very unusual situation historically because normally the Fed cuts rates when something bad is happening to the economy or they're very concerned that something is about to go south, and that's not the case right now. The Fed is not going to cut rates at their meeting this week, but they could begin to debate the conditions under which they would cut rates even if the economy is doing well. And that's because, as you said, if you hold nominal rates steady as inflation comes, and inflation has been falling much faster than the Fed anticipated, then that means that real interest rates are rising. And so I think, the committee now is going to get into some of these issues that they weren't debating last year because they couldn't have dreamed that they would be in this situation, a much better situation than they were in last year.
Well, I mean, I just feel like if we were to see 6 or 5 rate cuts in 2024, that would have to be a response to a deteriorating macro story. And you also have some of these warnings like a Jamie Dimon who continues to say we're going to have a recession, we're going to have a real slowdown this year. People are still debating whether or not that's possible. Are you surprised that we haven't seen a bigger impact from 11 rate hikes, Nick?
I think everybody's surprised that the labor market has been so strong through this period. Consumer spending has been very strong. I mean, after the third quarter where we grew almost 5%, everybody said, well, we're going to have a lot slower growth in the fourth quarter. And we had slower growth, but I wouldn't say 3.3% growth in the fourth quarter would qualify really as slow. I mean, that was strong growth in the fourth quarter. So I think you have two sides right now to this debate, Maria. One is that, some people are saying interest rates are going to get more restrictive if you just hold nominal rates steady. And the labor market always looks good until it doesn't. The hiring rate has been falling. You see less hiring right now in the U.S. economy. So even though layoffs are down, the unemployment rate isn't going up much. There are concerns that could turn quickly. The other side of this debate, you have people saying, well, wait a minute. If monetary policy is getting more and more restrictive, then why is the economy doing so well? And so as inflation comes down, that means real incomes are rising. People have more money to spend. And so the economy could do okay here. What's the rush to cut interest rates? And I think that's the debate the committee is going to be having this week.
I want to get your take on what Dick Beauvais is saying, Nick. He's the strategist from the Odeon Capital Group, chief financial strategist there, Dick Beauvais. He says China is going to soon overtake the American economy and the U.S. dollar will catastrophically collapse because of the debt, the deficits. Your thoughts?
Well, there have been a lot of calls about China displacing the U.S. as a reserve currency, for a long time. But a reserve currency requires a lot of things in which China, for now, doesn't come close to the U.S. We're talking about a strong rule of law, free capital flows, flexible exchange rates, independent monetary policy. I talk, Maria, to a lot of analysts who think the slowdown in China's economy is structural. It is caused by the end of an unprecedented expansion in debt, in credit, and investment over the past decade. So, China has its own issues right now to sort out. And it's hard for me to see, barring some dramatic change in geopolitics, what allows China in the near term to displace the United States as the reserve currency.
Okay. I want to get your take about what went on overnight at the Treasury. Of course, the Treasury reducing its expectation for borrowing, federal borrowing for the first quarter. The new number, $760 billion. That's actually $55 billion below the previously forecast number in terms of marketable borrowing. Your thoughts on these developments at the Treasury?
Well, it's a little surprising that these figures get so much attention in the markets right now. It used to be that the quarterly refunding just wasn't much of an issue, even in the financial markets, in the financial press. We didn't pay that much attention to it. But I think it speaks to the fact that the U.S. just has more debt to issue now. The deficits are higher coming out of the pandemic. And so, this is a major focus now. Who is going to buy this debt? There's a question here about the Fed's role, because the Fed has been effectively putting back $60 billion of treasuries through the runoff of their balance sheet, sometimes called quantitative tightening or QT. And, Fed officials talked at their meeting at the end of last year informally, but they began to talk about whether they should slow down QT. In part, that's because they've been doing it much faster than they did it 5 years ago, the first time that they ran off their holdings. And the question here is, could you go too far again? In September 2019, there were some disruptions in overnight funding markets. The Fed had to come back in and add reserves back. They're draining reserves when they do QT. So they have some more technical, tricky questions here around how long and how fast and how far do they want to let this run.
All right. Nick, let me go back to the Fed and what we're going to hear tomorrow. What are your expectations in terms of Jay Powell and how he's going to dress this up? We know we're likely not getting a cut in rates tomorrow, but what do you think Jay Powell says in terms of the statement? Are there things that you're going to be watching for tomorrow with the press conference?
Well, Maria, the big question is in the statement, what do they do with the tightening bias? For the last year, longer than a year, they've said that their next move is more likely to be an interest rate increase than an interest rate cut. And it's widely expected that they will get rid of that bias for, hikes being the base case. But how do they do that? I think there's a risk that, when they take the tightening bias out, the market says, aha, this means you're going to cut in March. And I don't think they're ready to signal that. I don't think they've certainly not decided they're going to cut in March. They're going to want to see how the economy unfolds. Again, strong growth in the fourth quarter doesn't exactly argue for you need to cut interest rates right away. So I think one question is, how do they massage the language in the statement? And then, of course, how does Jay Powell, the chair, play things at the press conference? Last time, he struck people as more dovish than they expected. He said, we did talk about rate cuts today. And so the market reacted to that. That could lead him to want to, be a little bit more careful. We'll see. He has every reason here to keep his options open. And so it'll be up to us in the press corps to try to pin him down.
All right. We will leave it there. Nick, always a pleasure. Thank you, sir.
Thank you for having me, Maria.